Just as we thought the most impactful crypto legislation was about to pass in the US, the Clarity Act, a post on X from Coinbase's CEO Brian Armstrong changed everything on January 14th. Just in one post, Coinbase withdrew all of its support for the bill that had been advising Congress on seemingly the last year or more. So I'm going to tell you exactly what Coinbase got wrong. Number one, de facto tokenized equity ban. That is just not true. The Senate markup of the Clarity Act simply just states that an equity is an equity. And so just because you trade on the blockchain versus the New York Stock Exchange does not give you any special differences concerning rules and regulation. You're still going to be governed by the SEC, and you still must submit to all the rules and regulations and disclosures that the SEC provides. So it doesn't really change anything in that fashion. Number two, DeFi prohibitions giving the government unlimited access to your financial records and removing your right to privacy. This one is also not true. The bill specifically says there's a DeFi carve-out, in which it says that if you truly have a decentralized protocol, meaning that it's open source, meaning that the node and validator system is community-based, and meaning that it's permissionless, and there are no centralized intermediaries, then you do not have to register. However, for Coinbase, it's different. They have the Base L2 network that's one of the fastest growing networks. However, Base is centralized. Base has a centralized sequencer, which basically orders and batches all of the transactions. Coinbase has the sole ability by itself to block certain wallet transactions from using its sequencer. Now, there is a way that you can go around that, but you won't get the super low cost and the fast settlement that you can get now using the Base network. The law simply says that if there is a part of the protocol that has a centralized intermediary, such as a Base sequencer, then they have to submit to rules and regulations concerning anti-money laundering, KYC, and everything else. So the law doesn't really change anything. It does give that free reign to actual true DeFi protocols, but it's not going to give that to non-DeFi protocols. And unfortunately, Base, which is a huge part of Coinbase's business model and ecosystem, is not decentralized. Some other protocols that this DeFi carve out would apply to are apps like Uniswap. That's open source. It's decentralized. It's permissionless. These are things that the Base network have some of those characteristics, but it's not totally permissionless because you do have that centralized sequencer. An example, Vitalik cannot block anybody from using Ethereum, but Coinbase and Brian Armstrong can block certain addresses from basically using the Base network via locking them out of the sequencer, which actually orders and batches these transactions. Thirdly, Brian Armstrong's tweet says that the erosion of the CFTC's authority, stifling innovation and making it subservient to the SEC. This is also another kind of false statement. If anything, the Senate version of the Clarity Act clearly separates the authority of the CFTC and the SEC. And these two guys, if you remember, were kind of arguing and bumping heads about who has jurisdiction over tokens like Bitcoin, Ethereum, Solana. The Senate markup actually goes into detail and describes the differences between a digital commodity versus a security. A digital commodity being something that's open source, that's decentralized, that's permissionless, and there's not any dependence on any centralized intermediary. Those are digital commodities. Ethereum, Bitcoin, Solana, Avalanche, those would kind of fit that category. If it is a security, then the Senate markup directly says that that is under the jurisdiction of the SEC, and commodities are under the jurisdiction of the CFTC. So it doesn't really make it subservient. It sort of divides those responsibilities. Furthermore, I think the Senate markup actually makes a good compromise. It says the CFTC and the SEC will actually come together and form a rulemaking body to make different rules in the future about crypto. Lastly, it says that the draft amendments that would kill rewards on stablecoins, allowing banks to ban their competition. Now, this one is partially true. It essentially is saying that Coinbase, for example, with the USDC, cannot offer a 3 to 4% yield on deposit simply because it's a payment stablecoin. There are bank lobbyists. We've already seen where Bank of America basically came out and said that if Congress allowed Coinbase and other stablecoin providers to offer yield, that basically would suck out 30% or 6 trillion of the deposit liquidity away from banks and harm the whole lending structure for the US. So I'm going to make a couple points on this. So I think on one instance, Coinbase is correct that the bank is trying to have less competition for deposits. But on the second point, the banks are also correct about the way the economy is set up. And I think this is one of the different factors between how Coinbase handles your deposits and how a Bank of America or JP Morgan or a community bank handles your deposits. For Coinbase, they take your deposit, they invest in T-bills or other slightly high yield instruments, usually safe, and then they give you back most of that yield. For banks, it's totally different. They keep a reserve requirement and then they lend out the rest. So most of that is getting lent out as mortgage loans, as student loans, personal loans, business loans, all of that. So they're supporting growth in the actual economy or businesses and schools, auto loans, everything, versus just holding most of it in T-bills or investments and then paying out some of that yield back to depositors. So those are the two very much different aspects. I would say the main thing is that eventually for unsecured loans, such as a business loan or a personal loan, which the banks do, we need a way to do that in crypto. And that's going to take more of a legal framework to do that. Because right now in crypto, all the loans are secured. You have a LTV of 70 or 60 or 80. And so that debt that you take out is totally backed by collateral that exceeds that debt. We're going to have banks willing to give out loans to people who may not have the collateral, but can pay it back in the future. And so this is going to be a combination of regulation, potentially working with companies like Coinbase. That is something that we need to find a way to tokenize, but likely that is something to come in the future. So Coinbase is partially wrong on that one, but they're also partially right. What's the angle? Most of the things that Coinbase's CEO, Brian Armstrong, said in his tweet are just wrong outside of the stablecoin yields. The one thing to note is that this is going to take time. And if you read the actual text of the bill, this is not a one-time bill. They set up processes and bodies to study things over the next year, come back with more rules, come back with more revisions. So this is going to be a multi-year thing, 3, 4, 5 years in the future before we really have a strong foundation on crypto rules. And things are going to evolve as technology evolves, just like all of our other laws. What should you do? Hold on to your Bitcoin and Ethereum. One thing to realize is that these are global systems and blockchains and tokens that everybody is using. Fundamentals remain strong. The use cases are there and the adoption continues. And that's what's the angle. Subscribe and tune in for more and see you next time.